Hello and welcome to the next episode in our SGH podcast series. My name is Rob Hogg, Chief Investment Officer at SGH, and today we're going to focus on the recent Australian February reporting season and delve into the results, key reflections and insights. Today I'm joined by Hamish Tadgell, Head of Australian Equities and Portfolio Manager for the SGH High Conviction Fund, which is our long-only broad-cap Australian equities strategy, investing up to 30 of our highest conviction Australian equity ideas. Welcome, Hamish.
Thanks, Rob, and it's great to be with you here.
Now, Hamish, we have just come through the Australian February reporting season. It's always a great time to get a read on the health of corporate Australia and insights into the economy. As well, it provides a sense check as to how the portfolio is going, and an update on your stock investment thesis for all holdings, and indeed for those you don't hold. So could we just kick off with a few questions then? Perhaps a good place to start might be a broad question. What were your high-level takeaways from the just finished reporting season?
Thanks, Rob. I think at a very high level, I'd describe it as a resilient reporting season against a more challenging economy. Clearly, we're seeing the ongoing bifurcation in the economy between particularly mortgagees and savers, and that's clearly influencing consumption patterns. At the earnings level, if we look at aggregate earnings for 25 and 26, we saw broadly about 1% downgrade to each year. And consensus earnings now for 25 sit at minus 3%. And for 26, plus 6%. So we've got that continued profile where the markets or investors are expecting a recovery. I think the other important point to note is that small caps, the earnings growth looks a lot better. So for 25, close to 9% earnings growth, and then into 26, close to 17% earnings growth. And again, I think that really reflects expectations of a broadening out in the performance of the small cap stocks, but also as we start to get interest rates cuts. Clearly we saw the first one in the month, but if that continues through the course of this year, it should also help in driving small company performance. The last point I just really want to make is that last reporting season, we actually saw very similar dynamics in terms of the earnings, but we saw valuations continue to expand and the market continue to outperform. This time, coming into reporting season, clearly valuations are even higher than last August, and I think look pretty stretched. And what we've seen is that even companies that delivered reasonable results or broadly in line results have really struggled to go on with it. And we've seen a number of companies, in fact, derated on what you would regard as pretty benign news around their results. And I think that's just more a reflection that the market is becoming more discerning and sensitive around valuations. And clearly, I think that was most evident in the bank sector through reporting season.
Great. Thanks very much, Hamish. So if we just then move from the high level and let's just start drilling down a little bit. So perhaps if we start at the sector level, where were the main surprises and key takeaways from your perspective, and how did the portfolio perform? What were the key areas of surprise, both to the upside and to the downside?
Yeah, sure. I think firstly, just maybe we start with the consumer discretionary side, given clearly that's been an area of great focus, given where the economy is and financial conditions, and I guess inflation and cost of living issues. As I mentioned before, it continues to be very bifurcated in the consumer side, and we saw a real mixed bag in the results, more downgrades than upgrades, but particularly sectors like auto, consumer services, and general retail, particularly apparel, remained very challenging. Some call-outs, JB Hi-Fi, another good result. Electronics sort of almost becoming like a staple these days in terms of people buying phones and computers. And the other one was really people trading down, looking for value, and everyday low prices, categories like Bunnings and Kmart and so forth, continuing to show pretty resilient results. And I think the other point just around the consumer is, I think, challenged, but employment growth still looks pretty solid out there. And that's the key message coming from a lot of companies. How we're playing that, I guess we've been playing the consumer discretionary much more through companies that have got structural growth and really attractive tailwinds. And so Aristocrat is a company that falls into that category for us. It's got the gaming machine manufacturer. Also, we added a company during the month, as you said earlier. It's about trying to find new opportunities as much as anything else through reporting season. And we added Light and Wonder, which is also in this electronic gaming manufacturing space and also is a digital online casino operator. It's a company we've been following probably pretty closely for the last 12, 18 months. The stock had been derated on a competitor trade practices dispute that it had. That dispute has now largely been resolved. And the result really provided some confirmation around the underlying sales in that business. And we see it as a really high quality business with favourable industry tailwinds. It's growing at probably mid-teens to high teens growth, trading on a mid-teens multiple, so very attractive. One of the other things I just want to highlight is just the industrials. So the industrials on the whole did it pretty tough through reporting season. In aggregate, there's about 5% downgrades to the ASX 100 industrials. And building materials in particular, I guess, is a big part of that industrial sector. And one of the key things to come out is the macro continues to be pretty tough. So we're not really seeing at this point a turning in the remodeling or the renovation market, and new home starts remain pretty benign. Those companies, however, are really managing their costs really well. So companies like James Hardie, Reliance, Reece, all reported very, very similar themes. But again, all of them are managing their costs really well. So we think they're really well positioned as the cycle does turn and as if we get more rate cuts to actually outperform. So we continue to have a position in James Hardie. In fact, we've added a little bit to it through reporting season on the back of the result. We thought that a lot of the key things that we're looking for in terms of that cost and leverage as the cycle returns. Also, the thing that we like about it, it doesn't have a lot of domestic exposure, particularly exposure to Victoria. Victoria was really called out by a lot of companies through reporting season as being very soft at the moment, much softer than the rest of Australia. CBA highlighted it, JB Hi-Fi highlighted it, Seven Group CEO there, Ryan Stokes, said Victoria's in recession. And it feels like that at times, I must say, living here. But they're probably a couple of the key points to highlight, Rob.
Great. Thanks, Hamish. Look, I guess one of the other interesting things, and this is more sort of a market-wide and technical sort of factor in some sort of sense, and that really was the fact that intraday average volatility for share prices was incredibly high, 7%, I think some analysts have suggested post companies reporting. What do you think is driving this volatility? Is it an aberration, or is it something that you think we're going to need to get used to?
That's a really good question, and I think a question that a lot of people are grappling with at the moment. It's really hard to pinpoint, but let me perhaps give a couple of points. I think firstly, there's no question that passive investing, systematic models, tracker type products like ETFs and so forth are a much bigger part of the market these days. In fact, some analysis I've seen suggests that sort of true active share in the market is around about 20%. So that's a big change. And so I think we're seeing reactions to share prices driven by that. The other thing which we have seen, I think, is the My Super performance test in the superannuation industry is, I think, seeing more money trending towards index or passive, or at least closing, I guess, that active risk. That is all leading to decrease in transactionable liquidity and amplifying volatility. The one other thing I would say is that there's been a large growth in broker consensus models and services. And that is, I think, leading to some crowding within the analyst community. So when we do get a variation or a miss, it's being amplified. And I think these things are structural. I think we just got to learn to live with them and navigate them as active investors. Our process is very much a fundamental one where we're trying to exploit the market inefficiency. So to some degree, or to a large degree, we look at these as hopefully being helpful to our process and what we're trying to do.
Yeah, it seems like it should be the environment where there's more opportunity to
exactly.
add value through active management. Now, look, coming into the reporting season, I just want to ask you about valuations. They've looked stretched for a while and became progressively more so during the course of the year. And just coming into Feb, the ASX 200 was trading on a PE of around 20 times. Now, you've highlighted that during the reporting season, in aggregate, earnings declined. There was a small amount of multiple derating. and some change in sector performance leadership with telcos and some of the more defensive sectors outperforming. We've also had the RBA cutting rates, as you mentioned. Are we starting, do you think, to see a rotation and a change in market leadership? What are your thoughts on that?
Yeah, look, there's a bit to unpack in that question, Rob. The first thing I'd say, there's no question that we've seen a strong run in markets, and that's been heavily influenced by valuation expansion over the last sort of couple of years. I think the August reporting season started to see some broadening out in the participation of the market, and we certainly saw some of the smaller and mid-cap stocks start to perform much better. You know, it's been quite a narrow rally up until then, concentrated in really the big cap stocks. I think this reporting season, we've just seen further evidence of that. So this broadening out, some of the smaller cap and mid cap stocks starting to perform better. I think it's important to remember that markets are forward looking. And so the other part to this is that with interest rate cuts, and if we are starting to reach a cyclical low, the market's going to look forward. And I think what we are seeing is the market starting to try to find value or some more cyclical stocks. I think in this reporting season, we've seen it's been more in, if I can put it, the defensive cyclicals. I know that sounds a little bit counterintuitive, but what I'm talking about there is really the defensives that are more interest rate sensitive, some of the more consumer facing, what I'd call early cycle recovery type stocks. So things like the REITs, packaging, telcos have all done a bit better. And through reporting season, we actually added Amcor, which is a global packaging company. We think it's got leverage not only in the domestic market, but more to the global market. And in addition to that, it's just announced a major deal with Berry Group, which is second largest packaging company in the US. And we see that there's going to be some strong synergies and benefits to come from that deal. We also added Vicinity more recently, which is a retail REIT into our portfolio. Again, you know, it's a beneficiary, I think, if the consumer starts to turn, but more to the point, we think it's got really high quality shopping centres. There's a shortage of supply of those centres, and it's continuing to get reasonable good rental growth. And if we start to see those sales recovery, productivity will improve, and I think that provides further leverage to rate increases. The more cyclical or later cycle stocks, a bit like the building materials stocks that I referred to before, still a little bit to go there, I think. And we probably need another rate cut or two to solidify the turnaround in those markets. But as I said before, you know, the likes of James Hardie, which we own, is really, really well positioned for when this cycle turns. And so we have a position there, and we think over the next 12 or 18 months, if we do see that turn in the cycle as we're expecting, then we should start to see some strong performance.
That's great, thanks. So as the cycle evolves and perhaps picks up somewhat, that will, as you've suggested, very likely lead to some change in terms of market leadership. Tell me, one of the great things about reporting season is that it gets a great opportunity to catch up with company management. We have management in here, we go and visit management elsewhere. What sorts of things did you learn during reporting season in your conversations with company management? They're the ones right at the coalface, obviously. And how is that feeding through into thoughts on the portfolio positioning?
Sure. Firstly, what was surprising, there was very little talk about tariffs. So tariffs has been clearly a big topic, but most companies at the moment are really talking to the ability to be able to pass that on if it happens. But I was surprised there wasn't a lot of talk about it. Maybe we'll get more talk about it as things evolve over the next sort of 6 months. We'll wait and see. AI continues to get a lot of focus. And what is interesting, I think, last reporting season, I sensed that there was a lot of talk about it, but we're actually starting to see some demonstration about how companies are using that, particularly how they're using it to improve service offerings to customers. So Computershare, IAG, the insurance company, Suncorp, our insurance company, Netwealth, Telstra, all highlighting how they're using it to improve their customer service and improve response times, using it to filter data, get the data back to customers, and they're completing forms, etc. So I think the key is that that's going to all help with the cost and taking costs out of businesses, which is particularly important in a higher inflation environment and when companies perhaps in a more challenging environment are struggling now to pass on pricing. Now, that's probably a good lead into the fact that pricing power has been a real feature or increase in price. Most companies over the last 12, 18 months have been able to increase prices to offset inflation. I think that's becoming more challenging, and that was certainly a theme through reporting season. What companies are increasingly having to do is focus on the cost to maintain margins. We're not seeing a lot in terms of cuts to labour force at the moment, but certainly the benefits of supply chain costs coming down is being banked, trying to find better productivity tools. I think overall there is still a pretty good discipline around maintaining margins. Margins did fall in aggregate over reporting season, but most companies are still trying to find ways to offset any inability to pass prices on.
So it really seems from many of the answers you've already given that really being invested companies that have really good management is as important now as ever, or more so.
Absolutely.
Tell me, banks, obviously a huge factor in the market, contributed enormously to performance of the overall market last calendar year. They were, however, a relative underperformer during reporting February. Did the bank results and trading updates suggest that anything's changed? Are there cracks? And how are you thinking about the banks now?
Look, I think there's no question coming into reporting season, banks trading on 20 times, 2 standard deviations above their long-term average. I think everyone was saying they look stretched. That said, when the rubber band's stretched, you never know what's going to be the thing that sort of causes it to contract. I think the sell-off during reporting season did catch a few people by surprise. I think it was probably the weak Bendigo Bank had a very weak result, and the Q1, the first quarter updates from Westpac and NAB, both had some issues in them. To your point, are they cracks, but just not as crisp, I guess, as the results we've seen over more recent times. And I think what we saw was NIM trends start to go negative, so net interest margin trends start to go negative. There was no one dominant factor that sort of drove that. There has been a step up in mortgage competition. There has been a step up in deposit competition around sort of funding costs, and all those at the margin have affected that margin. NAB also saw a slight increase in the non-performing loans or exposures, and it appears to be due largely to higher mortgage arrears and some weakness in the SME or the small and medium enterprise business areas. But asset quality, it still remains very resilient across, I would say, all the banks. So look, I think it's important to put it in context. They were quarterly results. Quarterly results can be a little bit noisy, and we need to be careful in extrapolating the trends too far. But I think our key takeaway is that it looks like the bank cycle has peaked or is peaking, and conditions aren't going to get better from here. And with banks on stretched valuations, their ability to outperform from here, I think, is constrained. They're still providing a reasonable dividend in terms of cash, maybe not an absolute yield, but from a cash perspective, fully franked, which is part of their attraction. But we're materially underweight the banks. We've got 8% in the banks versus the market at 21%. And during reporting season, we did take the opportunity to take a bit more off the table on our bank position. So, yeah, I think that it's important to watch, and I think, I'm not saying ignore it, but I guess it's an ongoing monitoring.
Yeah, I gather when you're paying as much as you are for the banks, as we are, some more so than others, when you're paying an awful lot, going from great to slightly less great is not good.
Yep.
So tell me, property trusts, REITs on the whole seem to report pretty well through the season, with continuing evidence of some of the headwinds over the last few years potentially abating. Further interest rate cuts are generally supportive for the sector. How are you thinking about REITs now?
Look, I think August reporting season, we turned more positive on the REITs, and for a number of reasons, which I think through this reporting season, we just gained even more confidence in those trends that we were seeing. So what are they? I guess we're seeing increasing transaction evidence, which is supportive for book values. Investors are coming back. They were on holiday for the last few years or longer. With the return of some investor liquidity, that's clearly narrowing the spread and seeing valuation stabilise a bit more. The other thing is that over the last few years, a lot of the REIT managers have actually gone through a process of, in some cases, forced divestment of non-core or weaker performing assets. So they've had this situation where they've almost had an upgrade to their portfolio. They've got rid of the underperformers, and that's seen a recalibration that's actually allowing better rental growth. We've seen that come through in a number of portfolios as well. The one thing I would say is that the trends in office were probably a little bit stronger this reporting season that we've seen last, but we still remain pretty cautious around office. We think the cycle has got a fair way to run yet. You look at the occupancy rates in Melbourne, they're still running at close to 20%. You look at some of the incentives, still 30, 40%. Sydney's a bit better. But as I said before, how are we positioned in this? We bought a position recently in Vicinity. We also bought a position probably about 3 or 4 months ago in Summerset. It's a residential New Zealand and Australia, I should say, retirement village business. At the end of the day, we see it very much as a property play and should benefit from the same themes that I've been talking about in terms of an upswing in the property market, particularly if we get further interest rate cuts, that should be a beneficiary.
I have to ask you about Goodman Group. They announced a very, very significant $4 billion capital raise at their result to fund future growth in data centres. That's clearly a very interesting move and seemingly supportive of what seems to be insatiable demand for data and AI. You've spoken a little bit about how a lot of corporates were talking about AI, but how are you investing and positioning around this thematic?
Yeah, another really good question, Robin. And I think that the capital raising came as a bit of surprise to the market, but clearly Goodman Group's got some pretty big plans and clearly I think sees very, very strong demand in this area, the medium and I think longer term future. I might just say that I think before reporting season, we clearly saw the whole issues around DeepSeek, and it's raised this question about AI and are we going to see the same level of demand for AI? Our view is that it probably only adds to the demand. And I think in speaking to companies like Next through reporting season, which we own, which is a dedicated data center play, there is no question that the general public cloud computing is continuing to grow very, very strongly. It hasn't slowed down. The change in GPUs around the DeepSeek and hasn't, from what they're saying, changed any of their customer demand or the way that they're thinking about it. You need to think that the investment in these things is very long dated. It takes significant time to get the infrastructure built, up to 2-3 years before you get planning and construction. The other thing is that they're just highlighting that the AI training and inference is changing the type of data centers you potentially need, but the overall demand remains very, very, very strong. And we're certainly seeing no slowdown on the investment levels from customers. We continue to think that sort of the AI GPU consumption is very, very much in its infancy. The other interesting thing from Next was just highlighting, which is a big part behind our investment thesis. And they've grown very successfully in Australia, but they're starting to move and invest more in the region. So Asia, Singapore, Malaysia, Japan. These are longer dated growth options. It will take some years before we actually see the benefits of it. But again, in our view, undeniable. And as an early mover, we think they have a strong competitive advantage, which will, and along with this sort of technical expertise they bring, have a very strong growth. Just on that last point on the technical expertise, I think it's important. One of the things we think about Goodman Group, we've got no question about Goodman Group and their capacity. They're very successful in building out the industrial portfolio. We think they're actually quite nascent in the data center space. I think it's probably quite astute that they're raising capital now. It's going to enable them to build out their technical teams and build out their capacity and capability to be able to deliver on that longer term ambition. We do think that there is quite a bit of internal growth that they need to go through in delivering on that.
Great, thank you. Let's have a look at a sector that's performed, well, quite poorly really over the last 12 months, energy, for something completely different. Geopolitics, policy uncertainty as well have been headwinds. I note that Worley's CEO, Chris Ashton, highlighted the outlook for the sector, in his view, remains very, very challenging. What's your take on this? And is this an opportunity or is this a warning sign?
Well, we fall in the camp of saying that it's an opportunity because we just think that the energy transition thematic is just undeniable. And we think that traditional, that is fossil fuels, as well as renewables and more sustainable forms of energy, will continue to be required. And it's not so much at this point a question about whether we need one or the other. We think very much that you're going to need both in delivering the transition over the next decade and beyond. To that end, we think that the domestic energy producers, in speaking to them through reporting season, the likes of Woodside, I know it's got offshore business, but it's domestic Western Australian business, Beach Energy and Cooper, or Amplitude, as it's now called, previously called Cooper Energy, changed its name recently, are all really well positioned in the domestic market, particularly Beach and Amplitude in the East Coast gas market, where we see huge issues in terms of shortage of gas. I think as we look at the ANEMO forecasts and the forecasts that the companies themselves are doing, are showing that there's really quite urgent shortfalls predicted in the next 12, 24 months. And what that's going to require is further investment. And these companies are investing now in East Coast gas in particular. The alternative is we have LNG import terminals. Now, it seems almost crazy that we're talking about this from the perspective that, we're rich in LNG domestically. We've been exporting it, and now we're looking to import effectively our own gas back, or gas from offshore back, to solve our energy problem. I think one of the big issues for the sector, and why it's probably struggled a bit, is the policy uncertainty. But I think we're reaching almost a crisis point where we have to get better clarity around this, or we are going to face some brownouts and issues. So yes, it's been a challenge holding some of these stocks over the last 24 months, but we still very much remain wedded to the investment thesis and the fundamentals, and more to the point, believe these companies, particularly the likes of Beach and Amplitude on the East Coast, have got strategic assets that are very, very well positioned to capitalise on this.
Thanks very much, Hamish. Now, look, in the podcast, we've covered a fair bit of ground. And look, overall, it seems reporting season was perhaps a little better than many had expected. But most importantly, the portfolio seems to have navigated the reporting season well, which I always think is a really good test of how a portfolio is structured as it goes through reporting season, both Feb and August. Tell me, in closing, what are the key takeaways and thoughts from a portfolio perspective that you'd like to leave us with?
Firstly, as I've highlighted, taking the opportunity to add a few stocks through reporting season, and Amcor and Light & Wonder, which we've been monitoring for a while, but just got that confirmation, I guess, through reporting season. The second thing I think is that the world is incredibly uncertain at the moment. It's hard to know what Trump's next move is going to be frank, and whether we're going to have tariffs or not have tariffs. And I think we can spend a lot of time thinking about those things, and probably the question is what end. What we're trying to do is really focus on the fundamentals and try to pick stocks that we think are well positioned to navigate that uncertainty. And really, in doing that, we're trying to find quality companies that have got a strong competitive advantage, that in attractive end markets which are growing, where they can capitalise on that growth, that are well managed, and then trying to buy those companies at sensible prices. The other thing that has hopefully come out of this discussion is that there's actually a need to be active and manage risk and valuation. We've seen the market trade a lot higher on valuation expansion, and I think during this reporting season, some of those valuations have been challenged a bit, where companies have reported reasonable results, but the market said our confidence in that going forward is reduced, and as a consequence, they haven't gone on with it or been marked down. So I think that focus on valuation, or as the way we think about it, margin of safety, in terms of what we're being asked to pay for the future earnings growth of a business, is absolutely vital at times like this. And really, that is fundamental to what we do and how we manage the portfolio.
That's great, Hamish. Thanks so much for joining today's podcast, which I should have mentioned is being recorded on Tuesday, the 4th of March. It's been great to harness all of your insights and hear how you and the team are navigating the current environment. There's clearly a lot of things to think about and a huge amount of uncertainty with everything that's going on in the world currently. But it sounds like focusing on the fundamentals and looking to invest in quality businesses at sensible valuations is, if anything, more important than ever in the current environment.
Thanks, Rob. It's been great to be with you and enjoyed the conversation.
No, it's been tremendous. And look, I hope for our listeners, we hope you enjoyed today's podcast. Please subscribe so that you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify or Apple Podcasts, and wherever you get your podcasts from. And please do let us know if you have any questions or comments. Equity Trustees is the responsible entity for the fund mentioned in the podcast. This podcast has been prepared by SGH High Company, SGH, to provide general information only and is not intended to take the place of professional advice. It does not take into account the investment objectives, financial situation, or particular needs of any particular person. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as an indicator of future performance. You should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product.
This podcast is produced by SG Hiscock & Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation or needs of any person and should not be considered a recommendation. The views in this podcast are those of the contributors at the time of recording. Neither SGH, SG Hiscock, nor any of its related parties provide any warranty of accuracy. Returns are not guaranteed. Please refer to the episode description for the link to the full disclaimers and disclosures.